Today we're looking at Alibaba. I'm going to take you into the fundamentals of this company, show you why this is probably the best value investment that I can find out there at the moment. I'll use my own assumptions, but most importantly I'll use analysts' assumptions to generate price targets for Alibaba. Look at this price, man. It went from its all-time high here, $309. I mean, it's $110. Let me show you some metrics here on Alibaba. So you can see it's a large cap company. It's the biggest company in China. It's a $300 billion market cap. When a company grows, it gets harder to grow the bigger the company gets. I would say when people like kind of get their eyes up for Alibaba, and when they really see that all this fear of delisting and this and that is not really a problem, it can easily turn into a $1 trillion company. So I'm not concerned about the size of the business being like a bottleneck for its growth, like I am with, for example, Amazon. Link up here to that video. Their price to earnings ratio is right now 28, and you might think that is kind of high for a company like Alibaba with this size of market cap. So let me just explain, guys. First of all, let me show you the forward PE on this thing. It's 12. It's 12, guys. Price to earnings ratio is basically just earnings per share from the past fiscal year divided by the amount of total outstanding shares. The forward PE is in the future if we take analyst estimates, and we got a lot of analysts on Alibaba, so it should be pretty accurate. The current PE doesn't matter as much, because if you go into the future like a couple of years and that PE is now 12, well, you still got a great deal. So that is why this price to earnings ratio is so low. Also, if you compare that to like Amazon, it's got like around a 50 price to earnings ratio, and the 5-year average has been like 104 for Amazon. Here it's 17. You get a lot more from your money at the moment with Alibaba than you do with, for example, Amazon. I don't know, maybe Amazon has a lot more growth in the future than Alibaba. That is up to you to decide. For the profit margin, we actually have a reasonable gross margin here, 37%, but the profit margin is low, 7.9%. They have a lot of different businesses. Some have higher profit margins than others. They have this site, Alibaba.com, where if you are a supplier of a product, a merchant, you can sell that there, and you can contact suppliers, and they'll basically make your product and put your logo on it, and they take some money annually for you to be able to sell on their website, and that is a low profit margin there. And they have other businesses, but one business that is really growing very fast for them right now is their cloud computing, which is their Alibaba Cloud. Much higher margins in that one, and same deal with Amazon. They also have this Amazon Web Services, and that is also what is expected to become a higher percentage of their total revenue, and that is a higher margin business, so that will drive up the entire profit margin of the company. When we make our assumptions here with the stock analyzer tool, we have to take that into account. So they have a price to sales of 2.2, and the free cash flow last year was $31 billion. That is a lot, but the average over the past 5 years has been 19.6 billion. So last year they had a great year because we were all staying at home, buying things over the internet all day. They do not pay out a dividends, which I think is great. They should just be using all that money for share buybacks and investing back into the business. No dividends needed here for me personally. If you look here at the 5-year return on invested capital, this is the return that Alibaba will generate on your money. So basically you invest $100 into Alibaba, they will generate a $10 return. But that is the average over the past 5 years. The past year they have been doing even better at 16.6% return on invested capital. If you compare that to Amazon, they had negative 6% the past year and 4% the past 5 years. Now we head into the income statement because we want to see if the company is actually growing their revenues, their net income. You go back 5 years, you can see they did almost $25 billion. Last year they did $112 billion. So that is like a 4.5x of their revenue the past 5 years. Incredible performance from Alibaba. We want to see their net income growing as well. You can see they did $6.8 billion 5 years ago. Last year they did $23.6 billion. And you can see that has been steadily increasing over the past decade here. So it's not just because of this situation that we have had. We want to see their shares outstanding either decreasing or staying the same. That is because we don't want to be diluted as shareholders. That means that they're issuing more shares and your share gets worth less. If they're doing the opposite, your share gets worth even more. You can see here 5 years ago they had 2.49 billion shares. Last year they had 2.7 billion shares. They have been issuing some shares, and that is not good. But there is a but here, and that is they have just announced like 2 weeks ago that 1 week ago that they're buying back even more shares. They had a share buyback program of 15 billion shares. Now they're buying back 25 billion shares instead. That is going to make up for a lot of what they have been, issuing a little bit of shares here in the past 5 years. The thing is, it's great when a company buys back shares because the shares are cheap right now. I'll show you my price target in a bit. If they buy back shares when the share price is high, that is just not as effective because they're buying overpriced shares. You're really not getting that much for your money. But if they buy back these cheap shares, that really makes a difference. Because they really, for the amount, the 25 billion, they get a lot more shares, and that is what will matter in terms of the scarcity and your share going up in value. So, yeah, that is just incredible from Alibaba here. You can see they have 75, almost 76 billion in cash on hand, and they have 164 billion in long-term assets, and they have only 37 billion in long-term liabilities, and their total liabilities is the same. They can pay off their entire liabilities 2x with the cash they have right now on hand, and yeah, basically they're in the greatest financial position you could possibly imagine. So no problem there at all. For the cash flow, we want to see that increasing. We go back 5 years, it was 10.2 billion. Last year was 29 billion. And their capital expenditures have been relatively stable here over the past 5 years. So although they have some investments in some infrastructure, they're not going as hard as Amazon, buying jets and all sorts of things. Not that is a bad thing, but yeah. There's something I'm missing here. It says out here in the 8 pillars, right? We can see that it is a 6 out of 8 pillar stock. But right now I'm actually getting kind of confused because it says net income has been declining over the past 5 years. But if I go into the income statement, it looks like the net income has been growing tremendously. We have two X's here, and normally we see if a company is overvalued, we see these two X's here. And that's because these two are the value indicators, but they are both green. We have an X here on the shares outstanding, and that is of course a problem. They've been diluting shareholders a bit, but really that is not really a problem when they have just announced that. So I would say this is not something that I worry about. The net income, as I can see it in the, I don't know, this net income, that kind of weird, it's kind of weird, but yeah, that's 1x. Does that mean we're automatically not going to buy Alibaba? Well, we have a stock analyzer tool, and that helps us put in our assumptions about the future to get a price target of what we should be paying at the moment. Here we have 10 years of analysis, and we have our historical data here. Let's start with revenue growth, 14 and 15. For their profit margin has been squeezed the past year because this whole situation. So the reason that I'm going higher here is because this low bad year that they have had is baked into that. So let's just say that this is absolutely not going to be forever. So I'm going to do 22 and 22 and a half. This could even go even higher. For the price to earnings, I put in the same price to earnings ratios as I did with Amazon, and that is because right now this company is a $300 billion company, and in 10 years with this growth, right, they're going to be a lot bigger. When a company grows, it can't demand as high of a price to earnings ratio because as a company grows, there's less potential growth ahead of it. Here for the desired annual return, I put in 12.5%. Reason for this is the return that I demand annually as a shareholder, and that will be baked into the price. Basically, you can get 9 or 10% in an ETF, in an S&P 500. This applies a nice 2.5% margin of safety, and this is an individual stock. You take on more risk by buying an individual stock, and it's also more work to go out and pick your own stocks. So that is a margin of safety that makes sure that you don't buy some like half bad deals. Roll down, guys. My high estimate here, and this is not even, You know, this is if they like come back to their normal profit margins that they've had. If they then develop the cloud business, they will easily be able to hit this profit margin. And let's say they do this 15% revenue growth, which analysts expect. Some years they expect more, some years they expect a little bit less. Let's say they do that and they have an 18 price to earnings ratio. We are looking at around $350 to $400 per share for Alibaba. For the mid assumptions, this is an easy 3x stock over the next 10 years. And guys, this is not the stock price what it should be. This is not even the best part, right? Because this is baked in with the 12.5% annual desired outcome. If you believe in these mid results, then you should be paying $300 for the stock if you want a 12.5% return every year. So basically a little bit more than the S&P 500 over the past century. If you want the like stock price, what it's worth with these assumptions, you go ahead and put in what an ETF could give you, and then you got your assumptions. High side $450, $500, mid 350, low 300. So when I look at Alibaba right now, I just look at it like to be honest, I get pretty happy because all my favorite investor friends, not friends, I wish they were my friends, but Charlie Munger, Ray Dalio, Monish Pabrai, he just sold again, but still, all these great investors, they are such huge fans of this company. It's a great deal for my own purposes, and then when I see these great investors go in, I immediately trust the numbers because they trust the numbers, and I know they have a lot of insider information. So, you know, that makes it for me, guys. Let's just take a look at what analysts think. I can make my assumptions, but analysts have their own opinions. An analyst maybe has like 10 stocks that he or she makes estimates about. Here are 27 of them that has made estimates of next year's results for their EPS, and they say it's going to be $8.2 per share. So let's just say they stay at this price, right? And this is why their forward PE is so low. They stay at this price, and then they do those estimates, which is the average, very important, by 27 analysts. It doesn't get like better than this, more accurate than this. And then you got a price to earnings of 13.2 times price to earnings. So basically, if they don't move, it's just if the stock doesn't move for the next year, and they just do the average. This is the average. That is not even beating the estimate. That is just the average. So basically, and if they do the low estimate, let's say they do the low estimate, 110 divided by the low estimate here, 7.61, you have a price to earnings ratio of 14.4. That is an unheard of low price to earnings. Compare that to Amazon right now laying at a 50. And if they do their estimates and stay at the same price, I did a video on it, go and check it out. If they stay at that, the price that they're at right now, they do the estimates for the current year, they lay at a 67 price to earnings. This company lays at a 14 if they do the bad estimate, the absolute low estimate. When it was at $75, and let's say they were there for the rest of the year, right? They did these estimates, they would be trading at a price to earnings of 9 in a year, right? You know, that is just these levels that the company is at right now, is just, they're just so low. So let's say for 2023, because we actually also have estimates for that. We take the average and we multiply that by whatever price to earnings we could see this trading at. So let's just say they stay at 30. We have a price of, you know, pretty much a triple right there. So it's not like rocket science to see that this company is undervalued. I don't care what you do with the numbers and the estimates, it just looks undervalued to me all the way through. So definitely looking to buy some more Alibaba. I'm actually kind of sad I haven't got any more. It's like, I think it's like 7% of my portfolio or some 5%. My smallest position, I think, actually in a stock. Yeah, it's too bad. Gotta buy some more of this amazing company. If you like this video, make sure that you like it and subscribe, and I hope to see you in my next one. Have a great rest of your day. Bye bye.